Traditional mortgages, they're dead. I'm going to show you DSCR loans. This is the exact loan program that investors are using right now to scale their portfolios faster than ever. And a lot of banks are terrified of you knowing this, and they don't want you to know about this because you can bypass bank restrictions and avoid all the endless hoops that you normally have to go through for these loans. And you can use this strategy to generate passive income and continue to scale that portfolio. So strap in, I'm going to go through and give you the full dive from A to Z. So whether you're new to investing or you already have a portfolio, this video is for you. The problem with real estate investing is as you start to purchase properties, you're going to have a mortgage for each one. So let's say if you bought these 3 properties, like you're going to have, let's say a $2,000 mortgage, then a $3,000 mortgage, and then let's say a $1,500 mortgage. Like that's a lot of debt that you're going to have in your name. And so the problem is these banks are not going to give you the funding that you need because they're going to look at your DTI and say, well, it's way out of whack. Even if it's being rented out, you need to structure your rental income for the IRS in order to show enough income. And it's a whole ordeal. So the point is DSCR loans say, hey, you know what? We're not going to look at that. We're not going to look at your debt to income ratios. I don't care how many mortgages you have, how many car payments you have. You could literally be broke and make no money. But what we're going to look at is the income from the property. All right. So here's how to qualify. We call it the 3 pillars of lending. So you have credit, you have income, and then you have assets. Okay. Now, for credit, DSCR loans usually require a 680 credit score. Do I have some loan programs that go down to 640? Yes, I do. Do I want to do those? No. And you don't want to either. Usually those loan programs are going to require like 30% plus down, and it's a lot of restrictions. So, but just know that like if you have equity or you have the down payment money, like you can go pretty low on the credit score spectrum. But for investment properties, just know, hey, for DSCR loans, we want a 680 plus, okay? And we're not going to use Credit Karma or whatever you see online. We have a different scoring model. So whatever you see, deduct 20 points, and that's your actual credit score, okay? Now, the next thing is income. So we use the gross rental income from the property that you are purchasing. How this is sorted out is with 2 different ways. We either use a lease agreement from the current property, okay? Or, my handwriting's so bad, or we use a 1007 form that the appraiser uses. So when the appraisal happens, he's going to assess the value and he's going to assess the gross rental income. Now, usually lenders choose the lesser of these 2. So the lesser of the lease agreement or the lesser of, or like whichever one is least, I guess, right? Okay. So that's for income. Nothing else. They only use the rental income for the property. Now, assets. They do require seasoning as far as like money in the bank, 1 to 2 months. You want to have 20% down. That's the minimum to start. There is a 15% down DSCR loan option, but the rates are so high that it honestly, in my opinion, it's the same as 20% with the amount of points that like they usually charge. So just know that 20% down is the way to go. If you're pulling out money from a property, right? If you want to pull out and let's say do a cash out refinance, 80% or 75% typically is the max LTV. It really depends on your credit score, okay? But just know that for assets, for purchasing property using a DSCR loan, you're going to need that 20% down closing costs, plus they usually require 3 to 6 months of reserves. It depends on the loan program. I would fair to say most of the time it's 6 months, okay? Now, moving on. Understanding DSCR loans at a high level is really important. So to recap, the minimum loan amount typically is going to be around $75,000. Your credit score is 680 or more. We have a lot of different loan options. You can do 30-year fixed, ARM, interest only, and there's no personal income or debt verification. Do you see the power in this? Like, do you understand where I'm going? Like, this is huge. I've had guys that have like 5 gas stations, 3 businesses, 2 properties here, the part owner in this, part owner in that. It's just too much. When they have a lot of paperwork, and especially high net worth people, if you're listening to this, you know who you are, right? You have a lot of different moving parts. To a traditional bank, they're going to really dig in. They're going to need to go through every single thing that you have, everything that you own, all the income that it sometimes, and you might be like wealthy, but on paper you're broke, right? Like you don't have any money. And so that's why these loans are so powerful, right? So there's 2 main types of DSCR loans. You could either do a purchase, right? Or you can do a refinance, right? Now for refinance, you can do a cash out refinance or a rate and term refinance. Rate and term refinances are used for like when you use a hard money lender, you buy a property and then you need to refinance to do a long-term loan if you can't sell it or if you don't want to sell it. That's where those come into play, okay? But those are your two main types. Now, this is something that a lot of people ask me on, so I'm just gonna answer it in this video. But like, how does it work when you're doing a cash out refinance, right? Like if I wanna pull equity out, which is why a lot of DSCR loans right now are being used because there's so much equity. Let's say you have a property that's now worth $450,000, okay? If you have a 740 credit score, the max LTV is 80%. If you don't have a 740 credit score and it's below, let's say for this example, your max LTV would be 75%. So lower your credit score, the lower equity you can pull out, or the more you have to put down if you're buying. Get the point? All right. So for a $450,000 property, the max cash out you can take out is $360,000. Let's say you owe though $300,000. So $300,000 is the hard money loan and rehab loan that you got on the property itself. Minus closing costs of that DSCR loan, you're gonna net $47,000. So that $47,000 is tax-free. That's what you can use to go buy the next property. But in a nutshell, that's how it works. Usually cash out refinances take about 3 weeks and the loan process is really simple. So you might be asking, well, how does it work? Like the actual process itself, and I'll get to in a second. When you're purchasing property, remember 20% down, right? As we covered. So 20% down, closing costs are usually 3%, and the reserve requirement is 6 months. Okay, so that's what's usually required if you have a pretty good credit score to purchase. Now this applies for 1 to 4 unit properties, so it can go up to 4 units, 3 units, doesn't matter. When you start going into the 5+ unit territory, so if you're buying like a 10 unit building, a 12 unit building, it's a little bit different, but the DSCR loan rules are still the same, okay? Here's a really unique loan program. I promise you most people probably clicked off by now because I know this video isn't the most interesting, but there's a HELOC program out that came right before this video was published. So you can literally get a home equity line of credit using only a DSCR like for income verification. Minimum credit score is 700. As you can see here, the combined loan to value is 75%. As you can see here, we have what's called a 1-to-1 ratio. That's what we need for the loan to work. That means that if the property is, let's say the mortgage payment is $1,500 a month and your gross income is on the rental property is $1,500 a month, then that's 1-to-1. It covers itself, okay? Usually they do a 30-year variable term. There's no prepayment penalties. No income documentation is required, and short-term rental is accepted, right? Powerful, powerful stuff. Really good way to pull out money. Okay, again, most people I already know clicked off this video, so if you made it this far, congratulations. One more thing, and then I'll be done. The process is really, really simple, okay? You do an application with a lender like me. I approve the loan. We then order the appraisal. We satisfy the last conditions, which will be like, hey, we need a copy of your operating agreement from your LLC, certificate of good standing, things like that. Once we satisfy those conditions, we got a good appraisal, right? Loans approved, applications complete, then we just get it clear to close. A lot of these loans are really easy to do. It takes 2 to 3 weeks. Now, I say easy to do to some extent. If your house is not in a good condition, there's issues with the appraisal. If your LLC is all out of whack, like I don't control that. That's just something on you that you have to figure out. But for the most part, just know that they are pretty simple. And look, hey, if you need help, just reach out to my team and I directly. I do a lot of these DSCR loans. I hope that helped. I try to give you a very high level overview of how these loans work and why they're so powerful. If you found that value in this, be sure to subscribe and I'll see you on the next one. My name is Ben. Thank you.